quick, Mike, this is usually your domain. This is what you do. Because you're the director of options education over at Power Options, and you're also the fellow that a lot of folks interface with when it comes to using the Power Options tools to search and manage trades. And it's not just married puts. It's a lot of things that Power Options supports. But I just wanted to show the customer experience. Is that okay? Because I'm a customer, or at least I was, for a number of years before I started partnering with you guys.
Yeah, and we just had. I just had 2 coaching sessions this morning, and one we spent about 50 minutes on talking about calendar spreads and some different techniques and adjustments on long calls and married puts. And then the last session I just had was going over a married put position, a couple married put positions that a radioactive customer has, a blueprint owner has, and he gave us some fantastic ideas for probably a webinar we're going to host, maybe I'll host, but just for blueprint owners only on some of the decision-making process of the different income methods. So it was a really good experience to go through historically and show him, okay, this is what you could have done, this is what you might have done, and then we'll present that maybe next week or the week after, maybe a week or 2 weeks from now for blueprint owners only.
Oh, super. Well, I might like to join you on that. I'll tell you what, it was kind of cool to hear somebody in the next office. I've just been eavesdropping a little bit there, Mike, while you've been talking with Power Options customers. And over I'm hearing the words blueprint, radioactive trading. I'm hearing hearing you talking about adjusting married puts. Just a lot of folks are calling in. That's a pretty big volume of your day, I guess. So I didn't realize how much. It's kind of flattering and cool. Well, let's go over to the married put, and I'm just going to do a search, and this is going to be real fast. I mean, look how quick I'm doing this, folks. This is amazing. And it pulls up a bunch of stocks that are on my list, the types of things that I like to trade. Right over here on the default, it says radioactive. There's other types of lists that you might use, or you can put in your own settings. But as a Power Options customer, I've got it real good. And I just put together a trade with Altera Technologies. And I decided that what I wanted to risk was about 6%. So I scrolled down and I found the January 55s here, 5.6% total at-risk amount. The dollar amount, if you pick up the stock and the put, is $3.28 with the current ask price on both, right? So, for example, it'd be $58.28 to pick it up, and it's a $55 put. So the difference between $58.28 and $55 is $3.28. So that's the maximum amount at risk. Now, assuming that I'm trading with $100,000, I could do 3 positions like this: 300 shares and 3 puts, and that would end up with me having at risk about $1,000.
Yeah, 1,060. 1,070, yeah, but in that range, absolutely.
Right, and then that would be less than 1% of my total trading amount, okay, or my total in the portfolio. So that's kind of cool. And of course, later on today, we're going to be talking about how to do riskless spread trades and how to turn a married put trade into a bulletproof position. And I have something really exciting I call the 2-step. I haven't really prepared slides on it, but I'm just going to discuss the possibility. It's something that was in the original blueprint back in, I call it the 2-step. Really exciting. Well, Mike, while I pull up the PowerPoint, let me, oh, somebody is already saying, I want to hear about the riskless spread. You know what? There's a little bit of background, buddy. In order to show the riskless spreads, and we're going to actually do 2. In order to show the riskless spreads, we've got to set some background so that you know where we're coming from and what context you can do it. Okay, so it's a bit of an education here. Okay, so Mike, let me run our first poll here. Okay, I just want to know what involvement folks are having right now with radioactive trading. If you have gotten the sketch, a free white paper that talks about how to put together what I call a radioactive profit machine. If you've been coming to the webinars or using the free YouTube videos and other free resources, if you're thinking about buying the blueprint or if you already own the blueprint, I'm going to want to know. Okay, so let's give it just a few more seconds here and let you fill that out. And I need to pull up one of our PowerPoint presentations. Got piles and piles of these guys. Today I think what I'll be sharing is the Humana Trade, because I said I would, right? We're going to do a repeat of Tuesday.
Okay.
Okay, good. Let me go ahead and that poll's been up for almost a minute now. Let me go ahead and close that poll and share the results. Okay, hello. What's going on here? Okay, there we go. Close.
There we go.
And share the results. Okay, marvelous. Okay, so the top, of course, is coming to webinars. That's good. I want to encourage everyone to come to more than one of these because we change the content from time to time, and you're going to pick up a whole lot. The blueprint, of course, has got scads and scads of income methods, but we always share one or two income methods at least, and of course the setup that solves most people's problems with trading. We've got 41 got the sketch. That's good. I'd like to see 100% having the sketch. If you go to radioactivetrading.com and read through that first page and then subscribe to our emailing list, you should get the sketch for free. Okay, so if you haven't got that, it is free. So definitely go and do that. 15% already on the blueprint. That's marvelous. And yet they're still here, right? Still here to maybe review the basics. So that's kind of cool. Okay, let me go ahead and hide those results, and just going to get an idea of what kinds of strategies our audience is using now.
Mm-hmm.
And folks, while you're answering that, by the way, answer as many as you currently do. Okay, don't just put one. Answer as many as you currently do. I'm going to mention that sometimes Mike gets very, very busy while I'm yapping, and I get busy while Mike is talking, because of folks posing questions that are actually probably pretty common questions that we've already placed within the context of the teaching. Okay, so not that we don't want to answer your questions, but maybe hold your questions until you have heard a lot. Okay, and we pause for questions, and you'll get a lot more out of the presentation. Okay, because you won't be focused on, well, answer my question. If you'll just listen to the presentation, we probably will. Okay, let me go ahead and close that poll there, Mike, and share the results. Okay, we've got 72% spread traders. It doesn't surprise me because the email that we put out was kind of a provocative title, wasn't it?
Yes.
I said riskless spread trades, and that's exactly what I teach how to do. I mean, wouldn't it be nice if you could do a spread trade that took a credit, but if it went against you, so what, right? Or wouldn't it be nice if you could do a spread trade that took into account what has already happened in the market instead of trying to predict what will happen next?
Mm-hmm.
And either way, those particular spread trades would not introduce any risk to your portfolio. That would be a really nice thing for a lot of people to have, wouldn't you say?
Absolutely, I agree.
All right, and you actually practice these trades, so we'll get to that later on. Second place, we got long calls and puts. 50% are doing the gateway drug, the cover calls, the naked puts, and 3% say options mean likey. Okay, folks that said options mean likey, I'm going to say that the only reason that you wouldn't like options is maybe being a little intimidated by the terminology and so forth.
Mm-hmm.
And the second reason is maybe you've understood enough but gotten hurt. And I'm going to say that both problems can be solved by education, and you can get that education for free here. And so let's go ahead and move into it there, Mike. Okay, have we done an introduction? I don't think we really need to, do we?
I think we're covered. I think we're good.
Okay, Mike's the coolest, and I'm the second coolest. Okay, so there's your introduction. No, I think the better introduction is what we can do for you. Okay,
Mm-hmm.
all right. We've talked about our credentials before, Mike, but here's the deal. What can we do for folks? Well, here's what to expect out of today's presentation. You're going to learn the biggest problem that faces traders today, but more importantly than that, we're going to find a solution. Okay. and a simple tweak that can drastically improve your trading if you do it. Now, I'll be showing 2 spread trades that take money now. One of them takes money now, and one of them guarantees more in the future, but they are done with 0 risk when they're done a certain way. And that's really exciting. Now, Mike, we already ran these polls. What's your involvement with radioactive trading? What kind of option strategies are you using now? But I'm going to go on. In this webinar, I'm going to make a bold promise, and this is the promise. I'll give you one simple setup technique, and it will solve the biggest problem that most people have with their trading and solve it forever. And we're going to actually do kind of a baseline reading using our polls and give a before and after picture. We're going to say, okay, this is what it was like before you knew this. Now that you know this, what looking back over the last year, what would your trading be like now? Okay, what would your trading be like if you had known this a year ago? How about that? And we'll see. On Tuesday, we found out that 100% of everybody in the line would have improved their trading. That's pretty good. Usually it's in the high 90s, okay, but last Tuesday it was 100%.
Right.
And I'm willing to bet that most folks that see this are going to wish that they had done it sooner. After we show that basic setup, we're going to run and see if it really would have made a difference. Okay. And here's another problem. After that, after we do that setup, I'm going to show you one method that can improve your potential returns better than selling covered calls because it solves the 2 problems that go along with covered call selling. Okay. And we're going to show another technique that can leave your upside open to growth but make yourself invincible to a downturn, something that I call bulletproofing, where we take a trade from low risk to no risk but still leave it open. Okay, kind of cool. So these 2 plays are only 2 out of the 10 income method adjustments described in the blueprint. And they're not even the most exciting ones, are they, Mike?
Well, it depends on the market conditions. They can be exciting, but it's not, depending on market conditions, there can be, and what your expectations are and what actually happens, there can be a lot different excitement, I should say, or increased excitement on some of the other 8 income methods.
Right, right. Income method number 5, for example, is very exciting to me because I can actually make more than the stock goes up. It's possible for me to make more than the stock goes up. That's exciting. Add to a winning position. But today what we're going to do is show income method number 6, which I actually this is wrong. I don't nickname it the money net. I nicknamed it "Give me my money now." Give me my money now. That's how I nicknamed that. And then income method number 4, the nickname is the ATM machine. Okay. All right. So if you do cover calls, if you were one of the 50% that said I do cover calls, you're not going to want to do it the old way ever again. Okay. And if you do spread trades, doing spread trades with 0 risk, that sounds pretty exciting. Okay. So let's get right into it. Okay. Oh geez, I'm going to blow through this. I'm going to blow through this. This is me saying, hey, look, is it fair enough for you to sit through this? If you sit through this educational part, is it fair enough for me to give you like a 3-minute sales presentation at the end? Okay, that's actually all I was going to say with all those slides there. So, folks, today it's 97% education, and it's going to be about 3% promotion. Because I do want to make it available to you to pick up a book that will show you even more of these exciting strategies. Okay, but first let's get into the education part. Okay, the 2 biggest problems with trading are kind of revealed by a chart I'm going to show you here in a minute. But here's what it is, Mike. The 2 biggest problems, it kind of comes from one problem. The one problem is that we just don't know what the future is. Right?
That's right.
Okay. And because of that, because we don't know what the future holds, our trading is ruled by our emotions, like it or not, of hope and fear. And the problem really is that we fear when we should hope and we hope when we should fear. And we're going to need to get a solution to those problems. Now, Mike, there's a saying, a popular saying. It goes like this: buy low, and what's the rest of it?
Well, you want to sell high.
Yeah. Buy low, sell high. When I first heard that, I thought, well, I'll just do that. That's what I'll do. And I'm sure a lot of folks have also made up their mind, hey, that's what I'll do too. But, you know, it's harder than it sounds. Have you heard this saying? Cut your losers short. I know you've heard it, Mike, but I'm asking the audience members now. Cut your losers short can you finish the sentence for me? Can you text in using the question pod there, and text in what's the rest of that? Cut your losers short, and there it is. Let your winners run, says Ian. Let your winners run, says Carl. Okay. Cut your losers short, let your winners run. We're having a lot of responses. Good to hear it, guys. Everybody's paying attention. Okay. Well, that sounds familiar, of course. But do we always do that? Probably not. However, Mike, years ago I decided that if there was a way for me to make sure I would do this, I would. And what if you could guarantee that you would do this? What if you knew for sure that if you had a loser, you'd be able to get out at a very, very small loss? Cut your loser short. But on the other hand, if you had a runaway winner, that you would be able to capitalize on that. And if you could always guarantee that you would do this, would that be valuable to know? Was it valuable to you?
Yes, it was. Absolutely it was.
It's been valuable. For the best premium, okay, when you trade covered calls, for example, that's our second place winner today. I think first place was spread trades. When you trade covered calls, and certain types of spread trades too, it's desirable to trade volatile stocks, right? Now, what's the problem with a volatile stock?
Well, it's going to have gaps, changes, ranges, multiple adjustments. It's going to bounce all over the place, and it has the higher potential for increased risk. In other words, increased losses with sudden gap downs or sudden shifts in the price.
Right. For example, if I was trading covered calls on this stock, that would be this particular stock is not a good candidate for a condor, is it?
No, no, sir. It's condors, butterflies, for example, short straddles, short strangles. These are all neutral positions, and this is not the type of stock you'd want to trade. Now, the premium would look great, wouldn't it? For an iron condor, for a short straddle, a short strangle, you'd get a lot of volatility, a lot of enhanced premium when selling those positions. But the whole direction of the trade is wrong. The whole direction of the underlying security is completely wrong.
That's right. If I was trading a covered call with this, can you see some places where I would make money?
Oh yeah, I mean, if you did a covered call, down at some of the valleys there, and the stock spiked up, you'd make your 2%, 3%, 4% return you were looking for, but at the same time, you wouldn't take advantage of some of the large upside gains without adding more money into the position and attempting to roll it.
Right. What about if I sold a covered call at one of those peaks, like that double top over there? What if I sold a covered call at that first peak, thinking that, okay, now it's going to go up from here, and then she crashes over the next couple of months? Would that be a real good?
Well, what would be tricky for me personally is if you did it on that first top there, I'd assume that you'd be using a stop loss of maybe 6, 7, 8% common by IBD. That first drop there looks like it's more than 8%, so you'd probably get stopped out of the entire position before it came back up. And if you weren't using a stop loss, maybe you survived that, and then you got clobbered shortly afterwards.
That's right. And also, if gosh, we had some folks talk about they're doing spread trades, or they're doing naked calls. Some folks, can you imagine selling a naked call there at that first double top? That it looks good for a little while, but then it's a runaway problem as that stock spikes up. Well, anyway, Mike, we could go on and on about this particular chart, but I'm going to say this is how I traded it. Mike, I actually traded this stock during the time frame that I'm showing, and what happened was I put together a married put trade where I bought stock and also bought an insurance policy. At no point could I possibly have lost more than 5% of my underlying capital in that trade. Not my capital total, but my capital that was in that trade alone. Okay, so I don't think that you could probably trade this stock with a 5% trailing stop loss and expect to do okay. You probably get stopped out right away. But I was able with my married put to do that. Now, 3 weeks in, I was able to do one of the adjustments that we're going to show today. I was able to do one of the adjustments and make myself completely bulletproof. And I did another adjustment that that I'm not going to show today, really, but I'm going to show a cousin of it. I'm going to show a variation of it. It's also a riskless spread trade, and was able to capture over 10% of what my initial investment was. I was able to capture a 10.22% gain in 6 weeks. So never had more than about a nickel at risk, and I ended up making a dime. Mike, would you flip a coin with me all day long if you could make a dime when you're right and lose a nickel when you're wrong?
Yeah, absolutely.
Yeah. Especially if nickel really means $500 and dime really means 1,000, right? So that's what this is about. Okay. All right. So I'm going to do a baseline like we talked about. We're going to find out how happy folks are with their trading results from last 12 months. Okay. And then we're going to show that married put setup and ask a simple question, and we're going to look back and see whether or not it would have been worth it to trade the way that I'm going to show. Okay? So first off, are you happy with your trading results? If you meet or beat your expectations last year, you should be happy. If you lost money, I understand if you're unhappy with your trading. And if you had gains but you didn't feel like those gains were enough, you might have mixed emotions. Okay? So let's do this baseline reading, Mike. I'm going to put it out there and leave it up for about 45 seconds. So folks, if you'll participate real quickly with this, that'd be good. It sounds like a lot of folks are still sending you in questions there, Mike. Is that right?
Oh, no, not a lot, Kurt. Just a few here and there. It's okay, actually.
Okay. Carlos says, I have one burning question about long-term married puts, if I can ask at some point. We will get to that question, Carlos. Okay, we certainly will. We don't want to ignore your question, but your question may be answered by way of the presentation itself. I'm not sure. Okay, so we've had that poll up for 36 seconds. I'm going to leave it up there for just a few more moments. Okay. Things are shaping up the way we normally see it. Fatter in the middle and skinnier on the sides, kind of like a bell curve. Okay, let me stop that and share the results. And we've got a tie between the extremes. We've got 7% say, yes, I made piles of money in 2010, doing good so far in 2011. And then another 7% say, my results sucked, I'm ready to throw in the towel. Okay, so, but in the middle we have our fatter results. This is where most people are concentrated, the other 86% that answered this poll. 28% say, I'm happy, but I could stand to be happier. Okay. That's actually good. It's good to see, Mike, that the first two answers, the first 35% there, about a third of our audience is happy with their trading. That's good. Okay. And about 2/3 are not happy with their trading. We have 48% saying mixed emotions. I've won some but lost some too. Unhappy says 10%. I'd rather take a physical beating than the beating I took in the market. So anyway, this is our baseline. We're going to come back to this with after we show a setup. Okay. Now here's what we're going to discuss. Okay. I posed the problem. The problem is that we don't know what the market's going to do next. Okay. And because of that, hope rules when we should fear, and fear rules when we should hope. And it dinks around with our timing. It dinks around with our emotions when it comes to selecting a stock. It messes with our money management. Okay, so why has the problem not been solved? A lot of folks know that they're not happy with their trading results. Today, Mike, we had 35 that are essentially happy, and 65% that are essentially not happy with their trading results. You know, mixed emotions. If you said mixed emotions, that's another way of saying I'm not happy, right? We did have 28% say I'm happy, but I could stand to be happier, but we had nearly double that say mixed emotions. Okay, so what do you think the solution is? Okay, I'm going to just run another poll. Okay, and folks, today the whole presentation isn't just about polls, you understand, but these polls, some of them are instructive, some of them are meant to teach a lesson, kind of like Socrates when he would teach. The Socratic method of teaching is that he would ask his pupils questions, and their questions would lead them to the wisest answers. Okay? Okay, so I'm going to ask, what do you think the solution would be for you? And I've put 5 different things up there. If I could wave a magic wand and magically grant you the solution, well, which of these 5 do you think it ought to be? Okay, do you need to spend more time trading? Do you need to pick winners more often? Is it that your timing is bad, or would you say you wouldn't mind losing if you just limit those losses? Or if you had a winner, would you like for your winner to win more? Now keep in mind, you can only choose one. You can only choose one thing from this list, and if I waved a magic wand and solved that problem for you, do you think that that would be the solution? Okay. All right. I've had that pull up there for a little while there, Mike. Let's go ahead and take her down. Close and share. Okay. What's the clear winner?
No, it's obvious. I wouldn't mind losing some if I could limit losses. 43% of our audience feels that's the answer.
Okay, and then what's the second place?
Well, the second place is that I need for my winners to win more.
Okay, and if we add those responses together, that's 73%. That's 3 out of 4. 3 out of 4 of our users today would like to limit their losses, right? Or have their winners win more. Okay, and I'm going to actually show a solution that'll do both. Now, for the remaining folks, number 1, I need to spend more time trading. I'm going to say that that's not true. If you do more of what's not working, Mike, if you do more of what's not working, are you going to have better or worse results?
If we do more of what's not working, we're going to end up with worse results, less results, right?
Okay. Yeah, that's right.
Worse position.
That's exactly right, and I found that that's the, it's kind of like the way the government spends money. I mean, if they throw more money at a problem, they figure they're going to fix it, but they may be throwing money in the wrong direction. Okay, and so they end up exacerbating the problem. I think a lot of folks online might agree with that, whether they're either end of the political spectrum. Okay. 10%. If I could only pick more winners more often, Mike, I'm actually wrong more often than I'm right. You've seen that.
Right.
My record over the last 3.5 years has been 47% winners. Now, if I was to go online and search for a stock picking service, and a stock picking service bragged to me that hey, last year we had 47% winners. I mean, would you be really excited to sign up for that program?
No, I wouldn't be too thrilled, Kurt. Honestly, I would not be too thrilled.
No, but see, the thing is, I made money the last 3 years. I made money, and the reason I made money is because I was able to practice those last 2 solutions. I was able to allow my winners to win more than average, and more importantly, I was able to keep my losses down very, very low. Okay, so that's what I'm going to share with you. Okay, Mike, cut your losers short, let your winners run. That is the idea. Let me ask everyone a question. Does the strategy of selling covered calls gel with that idea? Does selling naked puts cut your losers short and let your winners run? I mean, of itself, yes or no? Folks, I'm not going to put up a poll. Just, maybe use your question bar there to answer. What do you think? Okay, is that congruent? Does that gel? Does that make sense? Does a strategy of selling covered calls cut your losers short and let your winners run? Raja says no. Carl says no. I'd like to hear from the covered callers. So Mark says absolutely not. Okay. And we've got another Mark saying no. Not at all, says Giannica. I hope I said that right. Jim says, I don't have enough understanding to know. And that's okay, Jim. We're going to get there. Mike says, no, it lets your losers run. Bill, John, and Jim all say no. One of them with an exclamation point. Okay. All right. So we've got a pretty good consensus going on here, Mike. Does it actually, in fact, do the reverse?
Yeah, it's the reverse. That's right, Kurt.
Yeah, what we're doing is I've heard people complain to me that covered call selling is like a sorting machine, and what it does is it sorts the really good stocks, the winners, out of your account. Because what a covered call is, Jim said, I don't have enough understanding to know. What you're doing with the covered call is accepting a little bit of premium. You're accepting a little bit of payment to lock in a price. and that price is going to be favorable to somebody else if your stock goes up. If your stock goes up, you've got to sell it. Now, you're going to sell it at a profit if you set up your covered call trade correctly, but the profit becomes limited. It's kind of the reverse. You cut your winners short and let your losers run. Okay? All right, so I'm going to ask the spread traders. We got piles and piles of spread traders. I think it was 77% doing spread trades. Okay, so what about vertical spreads? Mike, does a vertical spread cut losers short? I guess what I mean is, are my losses predefined? Am I putting myself in a position where if I lose, I only lose a certain amount?
Mm-hmm. Yeah, you have a limited risk and a limited capped gain.
Oh, okay. But if my stock takes off, if I do a bull call spread, for example, if I'm wrong, I can only be so wrong. But if it takes off for the moon, Mike, am I going to make more than the maximum of that spread?
You can't make more than the maximum profit, Kurt.
Right. Okay, so they don't let winners run. Okay, so what's the solution? Mike, I looked at this chart, and this actually isn't my propaganda. This is from an educational website. When you sell covered calls, you own stock, and of course when you own stock, you're net bullish. You're definitely bullish because you wouldn't put your money into a stock that you knew was going to tank or you thought had no prospects. Okay, and when you sell a covered call, you do accept a little bit of premium, so that kind of gives you a little bit of a hedge. That's good. Mm-hmm. I don't agree that it's safer because the types of stocks that you have to trade to get the really sexy premiums are more volatile.
Mm-hmm.
And if they're more volatile, well, shoot, if it can go up 20%, can it also go down 20%? Yeah.
Absolutely.
Yes, she can. Okay, all right. But I will say this, where it says that the reward is limited, that is absolutely true, okay? And this is actually, I call it the gateway drug because most folks get introduced to the worlds of options trading by way of the covered call. And it's usually the first thing that you're cleared to do. It's the first thing that you get cleared to do when you begin options trading. But Mike, I thought that hockey stick was upside down.
Mm-hmm.
And if you look at this graph, here's another hockey stick graph. I took it from the same educational service, and would you agree that it's still bullish? I mean, part of a married put or protective put position is that you own stock. It's the major part of the position, right?
Right.
Would you agree with me then that it is net bullish even though you own a put?
Well, of course. We have an infinite upside profit potential. That's what we want to see.
Right. Would you go along with me that it is safer? I don't know about that first slide, but with the covered call, but I'd definitely say that this is safer, wouldn't you?
Yeah, we know our risks up front.
Okay, but instead of having it far over on the left where the reward is limited, now we have it far over on the right, and that's desirable. Does that sound more like it goes with our saying of cut your losers short and let your winners run?
Well, it forces us into that scenario, doesn't it, Kurt?
That's right. It forces us into that place, okay? All right, so we've talked about what the problem is. We've asked why we haven't solved the problem yet, okay? We went over 5 different possible solutions. And most folks chose, well, geez, if I could just limit my losses more. And second place was, well, geez, if I could just win more when I do win.
Mm-hmm.
I'm going to say that there's a way to do both. This is what's possible. Mike, we're going to go to radioactivetrading.com and take a look at the trade simulator tool. And when we do that, let me go ahead and jump up here, and we'll go to radioactivetrading.com right this second. Okay. All right, and this is our front page. Okay, we recently changed it. I hope you guys enjoy this. Okay, come and take a look. And those of you that said that you don't have the sketch just yet, front page, take a look at some of the testimonials on that, and see about getting the sketch. It's a free product. It's available to anybody that signs up. Let's go to the resources tab, Mike, and pull up the trade simulator tool and see what it is about this that is going to solve every problem. Okay. Now, sometimes when we've pulled this up, we've had a sound problem. Are you hearing me just fine?
It was dipping out a little bit, but it's so good. It's still okay.
Okay. All right. So this is what we have. We've got a virtual coin toss over here. This is a simulation. This is not meant to be a projection. Okay. Oh, by the way, earlier when I showed ALTR, that was not a recommendation to trade ALTR. That was a demonstration of how we would trade it, right? If we were to buy the stock and buy the put. Okay, so here we've got individual trade results. Okay, 3 losers in a row, 2 wins, a bunch of losers, some wins and losses. Okay, this is just a random trading record, and what we're doing is we're looking at different parameters. We had a target return of 10% and a loss limit of 10%, and we've coined 100 times, starting with $10,000. Mike, at the end of 100 tries, we might have, with 48 wins and 52 losses, we might take our $10,000 down to about $4,050. Okay, now that's not very exciting, is it?
No, it doesn't look that good, does it?
So here's the idea. Let's try and do better. Let's just try and be right more often. If we had more winners, that would change the picture, right? Mm-hmm. Okay, well it did. Here we have more wins than losses. Okay, we took our $10,000 up to $16,000 at one point, but we also suffered a loss. We were down at 72.15. That's a drawdown. All right, and we ended up with less than we started. That's not very exciting. Okay, what if we write more and more often? And this every time, so I can't predict. Let me just run times. Oh, good. Okay, here we are. Mike, with 54 wins, we took our $10,000 and rolled it all the way up to $33,000. Mm-hmm. Along the way, we also had a drawdown of about 30%. And at the end, when all the dust cleared, everything was said and done, we had a 35% gain. Look at that, $13,501, starting with $10,000. Okay, Mike, can I have you jot that down? Would you write this down? Mm-hmm. 54 wins, right? 54 wins. 10% target return, 30% drawdown, 35% overall win. Okay, why is this important? Well, I promised to say what was possible. Mike, let's go here to the target return, and instead of raising it, I'm actually going to lower it. And I know that sounds weird. Okay, that's what I'm going to do. I'm going to lower it, but I'm going to also lower the loss limit. I'm going to take it down to about what my loss record has been. Mm-hmm. Okay, my loss record has been 4%. Okay, now let that simulation see what happens. Okay, that's a little different. Mike, we actually lost more often than we won and ended up still making money. How about that? Mm-hmm. Let's run it again. Oh, that's a lot worse. Okay, look at that. We had 45 wins, so 55 losers. Took our $10,000 and rolled it up to $35,000, but what did it fall back down to? Oh, $33,805.
Right.
How about that? Along the way, did we have a really rocky trip? What was our biggest drawdown?
It was only about 12%, actually less than that, about 11.5%, right?
Okay, what was our drawdown when we were shooting for 10 gains? What was the drawdown before?
It was 30%, I believe.
What was our ending amount? Was it higher than this? I mean, it should be higher, right? We aimed for 10% instead of 8. Mm-hmm. What was our ending amount?
33,000.
Do you remember what the ending amount was?
Yeah, it was. Well, I'm sorry. The ending amount, I'm sorry, was 13,000.
No, the ending amount on the other.
Yeah, 13,500 or
13,000.
Right. Mm-hmm.
Yeah. Okay, so gosh, we had less of a drawdown and more of a gain. Wow. Isn't that what most of our audience said they needed?
That's right.
Needed their winners to, needed their winners to win more and their losers to lose less. And guess what? What I've done up here, Mike, I actually shot for a lower return. But the other thing that I did was take down this loss limit down into single digits. And when we did that, something really exciting happens. And what that is it's logarithmic in its expression. I'm not sure if I'm making sense, but the thing is, when you have losses, they exponentially increase how much you have to make back if you lose. Mm-hmm. Okay, let me put it another way. If you lose 50% of your account, how much do you need to do on your next trade to get back to where you started?
If I lost how much, 50%?
Yeah, if you lose 50%, do you need a 50% gain now?
No, I need 100% gain to get back to break even.
Oh, okay. So if you have a 50% loss, you need to double your money that you have remaining, which is a 100% gain, in order to get back to where you started. Well, if you have a 5% loss, 10 times less, instead of 50% loss, you had a 5% loss, how much of a gain do you have to get back to even on that?
It's about 5.2%, right?
Yeah, 5.2. A lot of folks would say, oh, 10%, but that's not how the math really works. Okay, we have to go to only 5.26%, and that's easier to do. You see, the thing that I've just shown you there, Mike, and I know a lot of folks don't get as turned on about this as I do, but guess what? If you're able to cut your losses down into the single digits, you can be wrong more often than right and still make money. Listen, don't take my word for it. I want you to take your own word for it, okay? I'm not even going to say add to your wins, because this time, just now on the the trade simulator tool, we lowered our win results, okay? But you don't have to. I'm going to ask you to look back mentally over the last 12 months and say, geez, if I was to limit my losses down to 6% or less, not the 4% that I showed, okay, which has been my record, but if you cut down your losses to 6% or less, would you be happier? And you just kept your wins, okay? All right, so let's go ahead and run that. If you kept your wins from last year, but kept your risks down to 6% or less per trade, or you're running several trades so that each trade had only 1% of your portfolio at risk, okay? How would you have done? Okay? Now, would you say, I would have said, yes, I'm very happy with my trading? Did you say no or mixed emotions before, but you would have said yes? Did you have a losing year, but that tweak would have made it a winning one? Would you still have lost, but lost much less? Or can you honestly say that you never had a loss that was over 6% or 1% of your total portfolio at risk at any time, but you still lost overall? Okay, let's give that a few more seconds to populate. Oh wait, nobody's, I haven't launched it. I'm sorry, gang. Let's start over.
Ooh. All right, let's try this again.
That's all my fault there, guys. I'm sorry. Okay. Would you have said yes? I'm very happy with my trading. No or mixed emotions, but would have said yes. If you had a losing year, but this would have made it a winning one. If you would have still lost, but lost much less, or you honestly never had a loss over 6%, but you still lost in your trading last year overall. Okay. So far, I haven't had any takers for that particular category, by the way. Okay. Now, we shouldn't leave that up for too long. I'm expecting a lot of real quick participation. Thanks, guys. I'm going to leave it up for another 5 seconds, I suppose. 3, 2, 1. Let's close her up and share the results. Mike. We had 4% say, I'm happy, I'm very, very happy with my trading before. Now we have 52% saying that. Before we had folks either saying no or mixed emotions, and now 35% of those that said no or mixed emotions, they would have said, yes, I'm happy with my trading. Okay? And 13% said, I had a losing year, right? So their percent return was in the negative last year.
Right.
This would have turned it around to a positive. Mike, is this 100% of our audience?
It is.
Well, yeah, it's 100% that voted. I guess not everybody voted. I'm looking that not everybody voted. But out of the folks that voted, everybody said, yes, this would have made a difference. Okay, let me go ahead and hide that. Okay, and then I'm going to ask you to put a dollar amount to that. Okay, just estimate. You don't have to get out a calculator and go over every trade from last year. But just off the top of your head, some folks might say, well, geez, I can't see how that would even help, to force myself not to risk too much. Why would that help? Okay. Or some folks might have saved at least $350. where some folks would be ahead in their accounts by 1,000 to 5,000, 5,000 to 10,000, or some folks, this information is $10,000 worth of difference in their trade just last year. Okay, let's leave it up for another few seconds. I don't want to spend too much time on the polls. 3, 2, 1. Please make your voice be heard. And presto. Okay, nobody said, I don't get it. Nobody said, well, I don't see how forcing yourself not to lose too much when you're wrong, I don't see how that would help. Everybody sees the wisdom of that. That's great. 11% would have saved $350. About a third of us ahead by $1,000 to $5,000. 28% would have saved or made $5,000 to $10,000, and another 28%. This information would have made $10,000 worth of difference. Mike, about this time last year in Colorado Springs, I did one of these seminars live. So rather than using this electronics polls, I just looked out at my audience and asked folks to raise their hand. One fellow raised his hand and said, "Try $30,000." And I said, "Wow, you just doing this tiny tweak, adding an insurance policy to your stock trades, that would have made a $30,000 difference in your year?" He said, "No, it would have made $30,000 difference in one trade." So that was pretty amazing. Okay, so how do we set that up? How do we actually do that? Mike, I'm going to show the structure of an RPM, a radioactive profit machine, which is my word for, or my saying, for a particular married put setup that I've been teaching since 2002 and that I've done individual trades with. Okay, here's a setup. Okay, I'm going to brag about a loser. This is one of my losers. January 7th, Mike, you saw me get into INTAP, Network Appliance, for $56.50, and at the same time pick up a June 2011 $65 put. Now, it's not even June yet, is it?
No, sir.
Okay. Yeah, this is like not 7 months out. How is that? 5 months? 6 months? 6 months out, right?
Right.
February, March, April, May, June. It's 5 months away. Okay. All right. So here's the deal. My total invested amount is $67.50, but because it's a $65 put, Mike, I can get out at any time for $65, right?
That's
true. If she crashes, if she crashes, I'm going to be able to get out at $65. So the amount that I have at risk is really just the difference between the $67.50 and the $65 put option. Okay, so in this case, the at-risk amount was less than the 4% that I showed in the trade simulator tool. It's 3.7%. Now here's the part where I brag. Mike, this stock tanked. It went down by more than 10%.
Right.
And I didn't want to fiddle with it anymore. I had done a riskless spread trade, which I'm going to show very soon. I'm going to show a riskless spread trade. I had done a riskless spread trade that won. It collected some premium, so that reduced the cost basis a little bit on the stock. But then I decided, you know what, I don't want to fiddle with this anymore, and I got out. So the stock is down more than 10%. How much was it down, Mike? Do you happen to recall?
I was actually just looking that up. I think it was around 11%. It turns out I'm actually not logged in, so let me try that again. I think it was around 11 or 11.5%, and the time you were in the trade, NTAP was down about 11.5%. And
okay.
What was your liquidation value at that time?
Yeah, my loss was 1.2%. 1.2%. One, because I had the put in place. Two, because I did a trade adjustment. I did a riskless spread trade. Didn't add any risk to the picture, but it did collect me some premium. Okay, and I got to keep 100% of that premium. And then three, I decided to terminate this trade before the put's expiration.
So you still had a lot of time value left.
Yeah, instead of exercising the put, I sold the stock and the put separately and got more than $65 for doing that. Okay. All right. So three conditions. Number one, the stock went down. But number two, I had done an adjustment. Number three, I decided to stop it early. So I didn't actually take a 3.7% loss. I took a 1.2% loss. That's worth bragging about.
And the stock was down 10.8%.
10.8. Okay, so while everybody else is losing 9 times as much, That's what it is. When you multiply 1.2 times 9, you get 10.8, right? Everybody else that was playing just the stock, they lost 9 times as much. Folks that did a covered call, maybe instead of losing 11%, 10.8%, maybe they lost, 7%.
Maybe 8, yeah.
Yeah. Intap hasn't recovered yet. All right. But I'm out, and I got out with a 1.2% loss. Okay, I like to brag about that. And the reason I brag about that is because, you ought to think about bragging about your losers. Brag about how little you lose. And the wins are going to start taking care of themselves. Okay? Now, here's the Mary put structure. If the stock goes up, man, you can do well. You can make money. All right? That dashed line, that break even, that really actually isn't a static thing. We can change where that break even line is by using the income methods. Okay? But even so, even if I did lose completely on this trade, it would have been only 3.7%. Regardless of how far down the stock goes. Okay? So that's cutting your losers short. All right? And letting your winners run, of course, is the other side of it. Okay, now, I'm going to, just before we show those riskless spread trades, Mike, let's just compare owning 3 positions. Each one of these is going to be bullish. One is straight stock, one's a covered call, one's a married put. Okay? If your stock goes up 20%, is that good for the person that owns stock?
Yeah, they're going to make 20%.
Right, okay. What about the guy that sells a covered call? Is he going to make as much or more or less?
Without putting more money into the position, the gain is capped. So if I have a covered call, the stock goes up 20%, let's assume we make 5%, which is a pretty rich premium.
Yeah, that's a pretty good, these covered call trading gurus have talked about 3 to 5% per month returns. So let's go to the top of that. Let's go 5% here. Okay. Now, a married put is going to make less, isn't it?
Of course.
Yeah. And what some folks believe is that they believe that the put comes down $1 every time the stock goes up $1. Mm-hmm. That's really not the way it works. If that put is far, far, far out in time, like the radioactive trading puts, and it's in the money, Mike, as the stock goes up $1, the put is going to come down, 25 cents or 30 cents or something like that, depending on where we pick it. Why is that? What's the reason behind that phenomenon?
Well, it's because we're far out in time and we went in the money.
Right.
And
okay,
so we're not going to be losing 1-to-1. The delta isn't linked there.
Right. Okay, so a lot of folks think that, geez, buying insurance is going to cut into your profits. And you know what? They're right. But it's not going to cut into their profits nearly as much as a lot of folks believe. In fact, in some instances, my stock has gone up a certain percent, and my net position of my married put has gone up more. That's interesting. Okay, but it has to do with some of these riskless trades that I did along the way. Okay, but let's just say that it makes 15%. Now, Mike, we made money in each of those 3 plays, right?
Mm-hmm.
Okay, because they were all bullish and the stock went up. Now let's put those winnings into a new play. Oh, darn, the stock goes down 20%. Is that bad for the guy that owns stock?
Yeah, he's now down 20% on his new position.
Okay, what about the guy that traded the covered call? Is he down as much?
Well, no, he hedged a little bit from the 5% premium, so he's down 15%, let's say.
Okay, all right, we'll be real generous and say that he got a 5% premium, which is kind of high. Okay, but what about the married put guy? If he structured it the way that I just showed, right? He's going to be able to keep his losses down into single digits.
Mm-hmm.
Okay, so he's let his winners run, and now he's cutting his losers short. Out of these 3 plays, what do you think did better? The straight stock makes and then loses 20%, so we're right at where we started, right?
No. It's not a wash. We'd like to think so, but it's not. We're actually behind now.
That's right. That's that logarithmic math that I was telling you about before, and that all of us need to learn and really examine. See, there's a net loss, and I'm not talking about commissions. There's a net loss when you make 20% and then lose 20, or you lose 20 and then make 20. Either way, it's the same. Let me illustrate, okay? If you had a 20% win on $100, your new amount that you have is $120, right?
Yes.
Okay, so you put that into the market, and then you lose 20%. Well, 20% of $120 is $24, right? So when you subtract your $24 from your 120, you end up with 96. It works the same way if you win first and if you lose first and then win. If you lose 20% of $100, you have 80, and then you've only got 80 to work with. You make a 20% gain on your 80. That's $16, and so you're going to end up with 96. You end up with less than what you started. Okay, so that's how that works. Now that whole process is exacerbated when you do a covered call, because look, Mike, do we make as much on the way up?
No, we didn't. We capped our gains.
Yeah, we did the reverse here of cut your losers short and let your winners run. We cut our winner short, and we let our loser lose much more than we should ever let something lose. I don't lose 15%, okay? All right, so I think this is going to be, more than double the net loss. With the stock going up 20 and then coming down 20, straight stock ownership, we lost 4%. Covered calls, we lost 10.75%. Okay, what about this married put deal? Makes less on the way up, right?
That's right.
But it loses a lot less on the way down. In fact, this is the exact reverse of what we looked at with the covered call, right?
That's right.
Yeah, it's the exact reverse of the covered call. Okay, so guess what happens? With this, we have a net gain. Pretty healthy one, too. Right? Now, remember, this was the same market. We're playing the same stock, and we're either leaving it just stock, or we're adding a short call, or we're adding a long put. But we had different end results. The stock-only strategy had a net loss of 4%. Covered call strategy had a much greater net loss. Married put strategy, the only one of the three, that had a net gain. And it's because we're practicing cut your losers short, let your winners run. That's why. Okay? All right, good. So that's, I'm doing a bit of a sales job here, Mike, but I'm not selling a product right now. I'm selling an idea. The idea is, look, guys, do you really want to keep risking too much? Most of us said, geez, if I could only limit my losses, that would really solve all my problems. Most of the folks on the line said that. And then when I gave the before-after picture, 100% said, well, that would have worked for me.
Right.
100%. Well, they said that. Okay, so what's different now? What's different now is, well, Mike, does this saying fit?
Again, we're forced into it now by this setup.
Right. Cut your losers short, let your winners run. Okay? All right, and let's just look real quick at the results of the polls here. Okay? Looking back over the last 12 months, we had our answers concentrated on either end of the spectrum. Some folks said, only 7% said, yes, I am very happy with my trading results. 28% said, I'm happy but could stand to be happier. Right? So that's 1/3 that were happy with their trading results. The other 2/3 had mixed emotions, or they're unhappy, or their results sucked. All right, so let's see how that changed. Instead of 7% saying, yes, I'm very happy, now we have 52% saying, yes, I'm very happy. All right? Some folks that said no or mixed emotions would have been happy. And 13% said that they had a losing year, but this would have made it into a winning year. And nobody answered the last two. Now, I realize maybe not 100% of our attendees answered the poll, but you know what? Of the folks that answered the poll, nobody said, well, that wouldn't have helped at all. Okay, so, how about you? If you did or if you didn't answer that poll, what do you think? If you're able to keep your losses down to single digits last year and keep your winners, would that have done something? Okay, well, Mike, we've got, about 10 more minutes. And I'd like to explain what else is different now, okay? Because after we start off that way, after we start off in a place where we could only lose a small percent, then we can make adjustments, okay? And I call them income methods because they're almost always done into credit. Some of them are not done into credit, but they guarantee a higher payout. We're going to show one example of each variety, okay? All right, Mike, this is the Humana Trade, which you saw me put together, I think, in February. Got the shares at $63.90 and the puts at $5.80. So the total invested amount is $69.70, and because the puts are a $65 strike, that means we can get out at 65 at any time, right? So the amount at risk is $4.70, or about 6.7. Now let me explain something about that.
Yeah, okay, go ahead. Go ahead, Kurt. You go first.
I was going to say that if I terminate this trade before August, there's still some time left to August, isn't there? Okay, and this trade is still active. If I decide to terminate before August, am I going to get out at 65, or am I going to get out at a better amount?
Well, you're going to get out at a better amount because you're still going to have time value remaining on the put. You're not exercising the put. You might sell to close the put and sell to close the stock. So you'd still have time value. This maximum risk you're seeing will only occur if you really hold the position all the way to expiration. You decide or choose to make no adjustments on the position, and the stock's still trading below $65 at August expiration.
Right, and I'm in control of 2 of those 3 factors, aren't I?
Yes.
Yeah, I can decide whether or not to make adjustments, and I can decide whether or not to hold it all the way to expiration. So even though this says 6.7%, I don't expect I could possibly lose more than about 6%, okay? And it's going to be less than that after the adjustments. Okay, so let's do an adjustment, okay? Oh, by the way, this is scalable. If you did 100 shares risking $4.70 per share, or you did 200 shares, you'd have to buy 2 puts. You'd still be risking $4.70 per share, and either way it ends up being 6.7% of whatever you put in, okay? Could you do 1,000 shares? Yeah, but you'd have to buy how many puts? Hello?
Hello? Yeah, if you did 200 shares, you have to buy 2 puts, right.
Right. If I buy 1,000 shares, I buy 10. Okay, so let's look at the graph. Here's how the graph looks. It's a hockey stick, okay? The blue line is expiration, and the red line is what that net position is doing at each of these prices with still some time left in the put, okay? Maximum profit is infinite, and the maximum risk is 6.7%. Okay, now, so we've set that up. That shows that Mary put risking 940. Okay. Now let's look at the graph of a bear call spread. Since we have 75% of our or 77% of our viewers are doing spread trades, they're going to be real familiar with this, Mike. Here I am selling the 6750s at 95 cents, and at the same time buying the 70s, $70 calls at 45 cents. So that generates a 50-cent credit. If I do that on 2 spreads, Mike, how much dollar amount do I take in?
Well, you're going to take 50 cents per spread, so it'd be $100.
$100. Okay, so that's what's being showed up here. The $100 net cost is a negative amount because what's happening is it doesn't cost me anything. I get paid $100. Okay. However, there's a problem, and the problem is that if the stock goes up, I'm going to end up losing. And how much could I lose? Well, because there's $2.50 spread between the prices, okay, the strikes, and I've done it twice. I could lose $2, okay, or $400 total because it's 2 spreads. See that? Let's put it another way. If I'm forced to buy at 70 and to sell at 67.50, I'm going to lose $500. But I've received $100 for my trouble, so my net loss is $400. That's my maximum risk. Okay, so Mike, that's the bear call spread. Now we saw the married put with 940 at risk, and we just looked at the bear call spread with 400 at risk. So if we put those 2 positions on at the same time, what total amount risk are we looking at?
Well, if you just added the risks, you'd say it's 1340, but that's not how it works, is it?
No. Okay. Here's how it really works. When we combine the risk picture, take a look at this. Okay. The bear call spread, if it does end up costing me the maximum of $400, the only way that it does cost me that is that the stock has gone up more than enough to cancel the loss. Look at this. Okay. If the stock goes up to $70, for example, and I have to deliver it at $67.50, well, shoot. You know, I'm still going to have those put options, and those put options are still going to be worth something, and I can get out of this net position at a profit. If the stock goes up higher than 70, well, geez, Mike, do I still have an unlimited upside?
Yes, we do. We've left our upside open, and we didn't add risk into the position.
Exactly. That's exactly what I'm getting at. You see, our maximum risk for the married put had been 940. Now, magically, it's 840. Why? Because we received a $100 credit.
Mm-hmm.
But if the stock goes up, how much risk is there in that bear call spread? Nothing. No risk, because I did it in the context of owning a married put.
Mm-hmm.
Now, instead of a net 6.7% risk, we have a net 6.1% risk. We still have the infinite profit potential. So what I've done here is I've cut my losers short, let my winners run, right?
Right.
Here's the deal. Here's the deal. If that bear call spread expires worthless, it's a recent one. It's actually an April bear call spread. If that was to expire worthless, that's already expired, and guess what? It cost me. But that's okay. If it did expire worthless, I would be able to do it again, because the put protects me all the way up till August. You could do this multiple times to take out all risk, and I've done that before, and so have you. Okay. All right, so, but here's another riskless spread trade. This is what we call income method number 4, and I put income in quotes there because it's not really an income at all. Okay. Oh, this is outdated. This particular slide is outdated because expiration has happened. All right, and right now I happen to be in Humana with a bulletproof position. Okay, but Mike, as it was going up, as Humana was going up, you saw me do another trade to take out even more risk, didn't you?
That's right. You had the income method number 6 in place, and then it continued to move up, and you decided to make another adjustment.
Right. Some folks have the objection that, geez, when you buy a put, that cuts into your profits. Well, watch this. Okay, I'm going to use the put. Oops, I think is that the right one? Yeah, that is the right one. Selling to close that August $65 put, and in its place buying to open an August $70 put. That would be a net debit of $2.80. Okay, here it is on the Power Options tools. Okay, here was my original cost for the put. It was $5.80. All right, and the original cost for the stock was $63.90. Now that the stock is up to $70, guess what? The put has come down in value. You see, the stock went up by what, $7 there, almost.
Right.
It had been $63.90, and now it's $70.72. Okay, so it's 18 cents off of $7. The stock goes up $7. The put comes down by $1.70. Do you see that? It was $5.80, and now it's $4.10. Do you see that?
Right.
That's that phenomenon that I was telling you about. That the stock goes up. If it goes up $7. And the put comes down by $1.70. That's about 25 cents lost for every dollar gained. I'm okay with that. But here, look, I'm going to sell that now for $4.10, and in its place buy $6.90s. Look at what's happened. The put price disparity there has changed my maximum risk from what was it before, $940?
That's right.
Down to down to $500. It's changed the percent at risk from 6.7 down to 3.4, about half. Okay. Now I know what you're going to say. We went from this married put down to this married put. Okay, less. And I know what you're going to say. You're going to say, hey, wait a minute, Kurt. You didn't include the bear call spread in that example. All right. Well, let's go ahead and also put in the bear call spread. Here's what it looks like. Okay. Now we have 2.8% at risk. 410 is what's at risk, and look at how the chart looks now. Do I still have unlimited upside?
That's right. Income method number 6 allows you to not cap your gain as you do with income method number 1, for example.
Yeah, and my risk is down to 2.8 now. Risk is down to 2.8 instead of 6.7 where it started. So it's like following this trade with a 2.8% stop loss order. Kind of cool. Okay. Now, can I do income method number 4 again? Why, sure. Why not? And this was actually Monday. Okay, Fishing members saw this on Monday. On Monday, I swapped the $75 put for an $80 put. May as well, right? Okay. So I spent $2.90, but spending that $2.90 raised the strike price by $5.
Mm-hmm.
Okay, so now we have a bulletproof trade in place. Okay, so the income methods reduce the gap of the the most you could possibly lose and the break even until finally, if you reduce it enough, you make yourself bulletproof to where you can't possibly lose. Okay, so that's really exciting, and of course your stock still has unlimited upside if she decides to keep going. Okay, all right, so here's what I like to say. My catchy sayings that go like this: don't pick stocks, pick stops. And I don't mean a stop order because that's finicky and it can betray you. I use a legal and binding contract to get out of my stock with a minimum loss. All right, but the other thing, remember those spread trades that we saw? I like to say don't time trades, trade time. You know, the income method number 4 trades were done in retrospect. They were done in a response to what the market has already done, and take out more and more and more risk out of the position until it's bulletproof. Mm-hmm. The income method number 6 trade, that was something that was put on in order to take a credit now, but introduce no problem. Mike, could I do another income method number 6 trade today?
Yes.
Yeah. Would I get to spend the money today?
Potentially, depending on your broker. Some brokers are strict about that, but yes.
Yeah, I mean, if it's in an IRA, then I'm not going to do it. I'm not going to spend that money. But the fact is that income gets put into your account. Now, if I did this correctly, would it pose any risk at all? I mean, could I lose any money?
No.
No, there's no way to lose. Okay, so that's the deal. Okay, guys, we've shown you what the problem is in trading, and we've talked about why it's gone unsolved. Remember those 5 choices I gave you, and most of you picked, geez, if I could just keep myself from losing too much, and then others picked, oh, geez, I wish I just made more when I was right. Okay, well, we've seen why it's gone unsolved. You now have a viable solution. The polls have revealed that 100% of those that participated said that their trading would be improved by doing just the first part, okay? But even beyond that, bulletproofing is really something, okay? You're able to take income afterwards, even while you leave the upside open. Mike, yesterday you and I, you were presenting, and I was listening in to a conference call where there's a bunch of financial planners.
Mm-hmm.
Do you remember that call? Yeah. And one of the things that they were talking about was encouraging customers to use margin for short-term bridge loans. For example, they own stock, and rather than going to a bank, they could get a very low interest loan against stock that they already have. And something inside of me was screaming. and what was screaming is the fact that, man, that stock can go down, can't it?
Mm-hmm.
Yeah. So if you take a loan against that stock to put into something else, like a real estate investment, or you just need quick cash to deal with something in your personal life or whatever. Okay, my goodness, why would you do that? But if you were bulletproof, if you had a put in place that made it so that you couldn't possibly sell that stock for less than what you've already put in, man, you wouldn't have any risk at all. You'd have infinite leverage. That's kind of exciting. That's kind of cool. Okay, and that's what I wanted to tell those professionals. But it was a kind of a closed deal. Anyway, Mike, we've done some pretty fun things here. Let me ask another poll here, and I guess we're at the end. We've shown what we
and I have to show something that's really important too from some of the questions that came in, and I'm only going to try to do it in a couple minutes because we are very far over and we have to respect everyone's time. So I'm going to try to get through that, but I do have something I want to show.
Well, did we fulfill our promises? We said that we're going to show folks how to get into a trade with very low risk, potentially turned into no risk, and did we also show 2 risk-free spread trades?
Yes, and Marcia wrote in, I apologize, Marcia, she wanted to go back because you felt the pressure for time. You realized we were over time, so you went through that last example a little bit quick, and she wanted to go back and look at some of those. Well, this is why we're archiving it, and I do apologize, everyone, for the fact that the two income methods didn't get started until actually at 1 p.m., and we don't want to skip through them. We want to fulfill the promise. But we archive these. They're available, and we'll let you know where they're available after the presentation.
Okay. We've got some pretty good response. I'm going to go ahead and close this. Mike, 7 out of 10 like the idea of taking income by way of spread trades that don't increase risk. And second place, the opportunity to adjust my risk and take income and the possibility of being bulletproof. Pretty cool. Okay, last poll, and this is it there, folks. And Mike, what were the questions that were posed?
I'll get to those. I'm only going to do 2 of them because I don't have the time to get to the others right now, but there's 2 specifically that I have to address, and I'm going to show that graphically because it's very important, and it supports why you need the blueprint, why you really need to consider the blueprint, or be patient and join us for other webinars and continue your education before doing the wrong thing.
Okay, very good. All right, so let me go ahead and close that poll real early. We'll give it another 5 seconds. 4, 3, 2, and 1, and presto changeo. 43% want to know how to find these kinds of trades. I actually showed it at the very beginning, Mike, didn't I?
That's right. We used the Power Options search tool there to show that.
And not everybody was tuned in at that time, so let me go ahead and send you out the link, okay? To find these kinds of trades, here's a free trial where you can, and you don't need a credit card or anything like that. You just go to www.powerops.com/RAT, put in your name and email address. You get 2 free weeks of this search tool to show you how to, not only how to find these kinds of trades, but also how to manage them. And Mike can be your instructor as to how to use that platform. There's no cost. Okay, let's get to those questions there, Mike.
All right, well, I'm going to steal the screen from you.
Okay, go ahead.
Whoops, hold on. Let me get in the right screen. I don't want to show everyone the other screen right now. Here's what I want to do. Carlos had mentioned earlier that he had a question.
Okay.
And, whoops.
Am I still showing the poll?
Sorry about that. That's what went wrong there. I apologize. Let me try this again, ladies and gentlemen. There we go. Okay. Carlos's question. Every time I look at a potential married put, I guess Carlos has been following us with some of the free materials. I'm not sure. I haven't looked him up. I don't think he owns the blueprint. But Carlos wanted to know.
Okay.
Every time I look at these on the Thinkorswim platform, I see that if I open the in-the-money married put, or you guys are doing it, and then, and by the way, when we open a position, there was another question that came in. Kurt and I, the techniques, we're always buying a put that's in the money. We're always keeping our risk in single digits. We're not going more than a certain range in the money. And we're always going far out in time. Those are some of the basic principles discussed in the blueprint and the foundations of radioactive trading, Steve. But anyway, back to Carlos. He says, every time I look at these positions and I look at selling a call, what I see is a lose-lose situation, that I can't make any money on the position. Sure, I have a limited risk, but there's a very small window to make money. And I'm not picking on callers, but this is a common mistake. This is why you need the blueprint. You've just seen 2 ways to adjust the position. But if you do it wrong, if you do any of these income methods wrong that may seem common to you, that you may think you know in your head, you can do them wrong and put yourself in worse trouble. How so? Here, everyone knows what income method number 1 is. Maybe you've read the sketch. Maybe you've heard us talking about it before. This is the Altera position that Kurt was looking at earlier today. Buying 300 shares of stock at 48.47 and buying 3 January 55 puts, January 2012 55 puts at 9.80. We look at the profit and loss chart. We have the 5.6% risk, a total of $981 there, Kurt, for the 300 shares. So that's below your $1,000, for example. Okay? Now, you're right. Carlos is right. If he sells a call right now for a reasonable premium, he's going to have essentially a small window of profit and a lose-lose situation, because that is the wrong way to do it. You do not jump in right away and sell a call. You know covered calls trading. You're familiar with it. Hey, I just bought a married put. I'll sell a call right away. That is a bad move. We looked at this position. We're thinking that Altera is going to move up in price. We want to protect those positions. Why cap our gains right away if we're expecting it to move up? If I jump in right now, and I'll even ignore June, or I'm going to even ignore May, okay, because it's only 16 days left. I'm going to go to June. And what would happen if I jumped right in right now and sold the 50 call for $1.25? What's going to happen to this position? Well, I'm going to cap my
Well, you're
gain.
going to limit your upside. Yeah.
I'm going to limit my upside. And I'm potentially going to increase my risk, not on the downside, but on the upside, in the direction I originally thought the stock was going to move. Yep.
Why would you do that?
12.3%. This is the problem with that setup clause. Of course, you're always going to see this limited window of profit with a lose situation on the upside and lose situation on the downside if you sell the call too soon, especially if you sell it below the put strike price, which is a no-no. You want to wait for the stock to move up and then sell the call that is at or equal to the put strike price. Now, let's say Altera did move up. Right now, the June sort of at-the-money call is selling for 125. Well, let's say in 10 or 15 days, Altera is at 55, and we could sell the June 55 call for $1.25. Okay, let's say the new at-the-money call of the stock moves up, that we could view that. How would that look? Well, let's add that in.
That would change. Yeah, that would change the picture, wouldn't it?
We're doing hypothetical. Stock moves up to $54, $55. We sell the 55 call at that time and assume that we can get about the same $1.25 for it. Maybe even $1.15, but let's assume $1.25. We waited for the stock to move. Then we'll sell the call that's at or equal to our put strike price. And now, this is a little bit better. It's not great. What would be even more interesting this would be an income method number 6, maybe an income method number 5. Maybe I'd use an income method number 4 at this point. This is why you need the blueprint. You can come to these webinars. We're giving you lots of information, lots of ideas. You're seeing some different income methods being shown. But without the blueprint, you don't have the knowledge of when and how you should be doing these setups. And if you do them wrong, that almost doubles your risk. The risk on the upside, if Altera suddenly spiked, was 12.3% on the upside, the direction you thought the stock was going to go. That's what you don't want to do. That's what I really wanted to address with the questions that came in. There are a lot of other great questions that came in, but as I mentioned, we didn't have the time for it. But this is really important to show that, yeah, covered calls, makes logical sense. I've got a married put. Let me go ahead and sell the call. That's the danger of doing it. Of course, Carlos, that's why on your Thinkorswim platform, when you're looking at the profit and loss charts, they're not lying to you. I mean, that's what it would look like. If you rush in too soon, sell the call below the put strike price, that's what you're going to see.
Right.
Sorry, Kurt.
And that's all right. Another thing too is the spread trades. If you were to do a income method number 6, can we scroll back up? Oh, are you still on?
Oh, I'm sorry.
Yeah.
Kurt, hold on one second. Let me get that back.
That's all right.
My apologies.
Let's scroll back up and let's put in an income method number 6 instead of income method number 1. Income method number 1 I would do only under very, very strictly controlled circumstances. Okay.
So you want to do a 6 from scratch or a projection?
Do a selling a $50 call first. Okay, $50 call, and that's it.
Current price?
Yep, current price, and we're going to get that nightmare of a chart.
Don't like it. Doesn't match my goals even. 2.2% doesn't match my goals.
Yeah, and to do this, we collected $1.25, right? You get $1.25 coming in. Okay, so let's scroll back up, and let's add into that a long $55 June call. Okay, and so what we will have done is change it into a bear call spread. So you buy.
We're going to use the natural at 30.
Yeah, so instead of taking a $1.25 credit, now we only take a 95-cent credit. Okay, well, do we still have an unlimited upside? Yes.
Interesting, yeah, we do.
How about that? And we've reduced our risk from 5.6% to 4.2%. Okay, so that's a much better situation, I think. Okay, the only way that you can lose here is if it closes right at 55. And Mike, would I do this at that time? Would I do income method number 6 right at this time when doing it could possibly lose me some money? Probably not.
Right.
Probably not. I would probably wait just a few more days, or I might choose a different income method. There's 10 of them, for crying out loud. But we want to leave the upside open. if the stock travels in your direction, and we don't want to limit our we do want to limit our losses.
Right.
And take. So anyway, that's the sum and substance of radioactive trading, isn't it? To put yourself in a position, we don't know what the stock is going to do, but in case it does what we hope it will do, we're going to do very well. And in case it doesn't, so what? You know, we lose like nickels. Okay. Now, as we finish up here, Mike, I think some folks, you can go ahead and give me the screen back.
Working on that, sir.
Yep.
Here we go. You should be good. Just show your screen again and ready to roll.
Good. I think some folks did want to know how to get the blueprints.
Yes, they did.
All right. So let's go ahead and review the offer. The offer, part of any offer is what you get, what it'll cost you, and what you risk. Okay. So here's what you get. The blueprint is 250 pages of instruction on limited risk, high potential return trading. Don't be intimidated by 250 pages, okay? What it is lots and lots of examples and lots of income methods. But the really valuable stuff, the super valuable stuff, is the first 3 chapters. And then after the first 3 chapters, you can kind of specialize. You can decide, you know, depending on what market we're in, and we give a summary at the end of the chapter on each of the income methods, which market you might want to deploy them. Okay, then you can master those individually. Just take your time with it. Okay, you don't have to read all 250 pages at once to begin trading radioactively. We're including 3 bonuses: the quick action guide, which will teach you how to get into these types of positions and how to find them easily. The Foundations of Radioactive Trading CD, which details how to limit your risk in each position to 0.5% to 2% portfolio risk. So, for example, if you're trading a $100,000 account, you know, keeping your risk in any one trade to say 1% of that entire account, okay, and maybe 6% in that individual trade. And it'll show you how to allocate your funds and so forth. Also bulletproofing. Okay, a free month of Power Options. That's the service that I showed at the very beginning, and it took me, what, 45 seconds to find that Altera trade?
Right, and we just showed some of the other tools that are available so you can actually analyze the positions and keep yourself out of trouble using those profit and loss charts.
Right. Here's the other part of the offer, or the next part, what it'll cost. It's $339. Now, Mike, when we did this poll earlier, okay, one of the answers was, geez, you know, what dollar difference, how much better would you have done last year if you had only done the Mary Put setup? Not talking about the riskless spread trades, not talking about bulletproofing. But, geez, if you just kept your losses down to 6%, the way that I showed by using a Mary Put that's far out in time, 11% would have saved that $350. Okay, so I paid for your blueprint already. Everybody else, I paid for a blueprint for you and for your friends. Okay, so there's that. Okay, what it'll cost is $339. Now, here's the last part of the offer. The last part of the offer is what you risk. You know, Mike, if we were looking at it as an investment and we set up 100 shares and bought a put option and $339 is what we're risking, well, there's no limit to how much we could make from it. But how much could we lose? We could lose the $339, couldn't we?
Right.
Okay, so I want you to look at the blueprint as an investment that way. Okay, if it's as valuable to you as I think it will be, your $339 is a wonderful investment. Okay, but if I'm wrong, or if you're wrong, you decide, you know what, I'm going to try it. I'm going to go get that blueprint. I'm going to go ahead right now. I'm going to go on to www.radioactivetrade.com. I'm going to pick up the blueprint. What if you're wrong? If you find out that, man, it's not for you, geez, then the most that you are out is $339, right?
That's right.
Well, wrong, because we have 100% guarantee. And that means that if you are unhappy with the blueprint, even if you don't like the way I part my hair, and that's a little bit of a joke because I'm completely detached, okay? You don't have to give a reason. If you're just not happy with the blueprint, shoot, send it back. It's a 100% guarantee, okay? So what you risk is nothing.
Yeah, and Mark just wrote in, have some questions with Mark earlier, and I appreciated Mark's feedback, but Mark just wanted to know that based on what other education and services charged, we're undercharged, but he told us we can feel free to adjust it right after he places his order.
Very good. Yeah, I think we do undercharge. You know, I was speaking on the phone with a gal from Texas, and she told me that, geez, you know, I went to a seminar that cost literally 10 times as much. She went to one of these covered call training seminars, and it cost her 10 times as much as the blueprint costs. And I said, well, what about the value? And she says, well, to be honest, I haven't retained more than about 10% of the information. So I said, okay, you spent 10 times as much and you get 10 times less.
Right.
She says, yeah, pretty much. And so the blueprint has not only does it have a money-back guarantee, but it also has support. If you happen to already own the blueprint, you know, you probably already know that we get back to you very quickly if you email questions or if you have questions about how the income methods apply to your particular situation. You know, we're not going to tell you.
Kurt,
go ahead.
Let's just, yeah, I'm sorry, I didn't mean to cut you off. Let's show them where they order. Those are the questions that are important. Let's show them where they go.
Oh, okay, all right. More questions are coming in and how to order. Let's go to www.radioactivetrading.com, and I'm pushing that link to everybody, and we're going to also show you that page. Here it is. Just scroll up to the top on the Products tab on radioactivetrading.com. Oh, and listen, this is new. The whole book is not an audio book, but because, you know, we don't want you to wreck your car, all right? A lot of it's graphic. There's a lot of pictures, okay? So we don't want you to wreck your car, you know, trying to visualize what I'm describing. But the first chapter is in audio form, so if you just want to listen to the first chapter, you can do that free. So here it is on the products page. The blueprint is $339. I'm going to recommend that you pick that up and got risk nothing if you decide that it's not your cup of tea. Okay. All right, Mike. I think we're about done. Any other questions that are real pressing, or shall we?
No,
go ahead
I've
and
answered.
sign her off?
I've answered most of them, and then of course we'll review some of the questions. I'll be sending emails out to questions if you ask questions at the end. For example, we'll get those answered as well. Then you can always join us next week.
Okay. That's right. We'll be here at the same bat time, same bat channel.